starting with the stock market, we're looking at a phase of topping and correction, and including a potential 50 or 60% correction before it's done. And that all reverberates around like in the 1960s and 70s. You could follow the 60-year cycle as a good example. Then you start up again. Then you get another bull, okay? So from 2042 on, it could be dramatically better.
Ooh, okay.
The gold market is probably going to be in a recessionary psychology rather than a bullish psychology, at least until 2027. And then it goes bullish. Then it takes off. So gold would be a value. Bitcoin is hard to say because there's not that much history on it. I wouldn't want to make an opinion on that because I don't have the tools to evaluate it correctly. The currencies obviously are related to the dollar, is related to the interest rates. The likelihood, again, is interest rates will probably go up because there's a 60-year cycle in interest rates. We were off by about 2 years, but we're in the beginnings of an increasing phase of interest rates. We're in the beginnings of remembering value. We're in the beginnings of getting away from the craziness and the speculative fever where value is irrelevant and corporate buybacks rule the world and zero interest rates allow people to borrow money for free. And all that's ending. We go back to the ground. The ground is where things are real. And so that by 2042, we're back on the earth. You start operating in terms of values that are more sensible, more realistic, and probably more long-lasting for the future. I'm not a doom and gloomer. I'm not thinking the world's coming to an end in terms of the environment. But I do think we're going to go through some chaos because...
Welcome to the Rose Show podcast. Welcome to the Rose Show, your ultimate independent source for achieving true wealth. Today, we're going to talk about predicting the stock market. Is it even possible? Well, Allen Reminick, a former math professor and an advisor for over 4 decades to professional traders as well as commodity trading firms, says, yes, you can predict the stock market. I don't believe it. So I had him on the show to try to convince me. I don't know about you, but predicting the stock market, that sounds impossible, right? So I told him I want him to show us and convince us. So he came on the show and he shared some of his secrets and he showed us many awesome charts, wave patterns, step cycles, GAN, algorithms. It was very convincing. Okay, I was convinced. Pretty awesome stuff. Amazing show. Enjoy it. And you tell me what you think in the comments. Subscribe to the channel and enable notifications to stay ahead of all the latest. Thank you for joining us today. Today's an exciting day. We have someone on who says that you can predict the stock market. His name is Allen Reminick, and he's a former mathematics professor, and he has over 4 decades of experience advising professional traders and commodities trading firms. So how you doing today, Allen?
I'm good. How are you today?
Great. I'm so excited to be speaking with you. And you make a very bold claim. Yes, you can predict the market. So I'm excited for you to show us and teach us today. Are you up for that?
You betcha. So,
awesome.
So the thing is this, like almost nobody believes it. I mean, Wall Street is set up on the assumption that you can't forecast the market, right? As a matter of fact, it exists because of that, right? If you look at the distinction between the stock market, which has been around for hundreds of years, and the commodities market. So why are there 20 times as much money in the stock market than there is in the commodities market? Very simple. The stock market eventually always manages to go higher. That seems to be it. I mean, it's a trend, and the idea of the trend is your friend and kind of buy and hold and hold and hold and hold and hold. Mm-hmm. If you live long enough, you make a lot of money, okay? The trick is there a better way? And is it possible to improve upon the buy and hold strategy? And I claim, and I've been demonstrating for now 30 years that you can. And the reason you can is because there's a mathematical orderliness to life, and there's a mathematical orderliness to the stock markets that's generally not visible on the surface. If it were visible on the surface, it would be a different entity because everybody would be rich. And in the stock market, not everybody can be rich. Somebody's got to lose. So the way the game is set up is basically the assumption that human beings run the show. The large firms are buying and selling massive quantities. It's all in the hands of the professionals and such. Up to a point, that's true. But the truth is, mathematics is still ruling the game. Ultimately, it comes down to the forecasting is basically locating patterns in history that are repeating in the present. Patterns that have been there in the past, repeating in the present. If you have the skill to locate which particular patterns in the past are repeating in the present, then you can, as it were, draw a roadmap on a good approximation of what will happen going forward in the future. You don't need to have, you don't need a Ouija board, but you do need the ability to recognize that orderliness is based upon the organization of the market is based upon time. Everybody sees the surface level of life. They see the price. They feel the speed of motion. A very fast moving market is attractive. Everybody wants to get in real fast, make a lot of money in a hurry. But they don't understand the deeper levels of the market. For example, you take a person, you go to the doctor, and the doctor looks at you, sees if your eyes are red or green or whatever, and how your posture is. But in order to know more, you need to take the blood pressure. You need to get internal statistics on what's happening inside the market that aren't visible. What is visible is the price. What is visible is it goes up 5 points, down 5 points. You can recognize, and you're familiar with that. But the professionals have gone deeper. They've got the blood pressure. They have ways of measuring whether or not the internals, in terms of how many people are actually buying, how much volume is happening today on the up volume, how much on the down volume. They even have it to the point they know who is buying, and at second by second where the pressure is in terms of upward motion or down. So they're measuring internal structure in order to get an understanding. But even that is still not a holistic theory. Okay, it's kind of more like going into battle, and okay, the wind is coming from the left. I'm going to move to the right, like that. It's like weather forecasting, trying to put together a bunch of variables, trying to forecast the weather based upon there's a high pressure center coming from this side. There's a certain level of humidity. The temperature is 63 degrees, and it's likely to go higher because there's a barometric pressure up here. All these variables. This is how people forecast. Generally, it's by taking massive amounts of data and trying to combine it in an intelligent way to come up with, this means that the market's going up. This means that the market's going down. And you've had experts on, and you're interviewing people all the time that are very, very skilled at reading the pulse of the market, at picking up on the internal structure of the forces that are building momentum before they actually sprout that momentum. We know interest rates are going up. Well, what happens when interest rates going up? Generally speaking, this will happen to the economy 2 years later. They talk about a variable lag, a long and variable lag, but nobody knows how long that long is or how variable that variable is. But they do know that there is a general economic tendency for A to follow B, for A to be causally related to B, but they don't know exactly how. We're going to look one level deeper, which is the invisible area of time itself. Time is the least obvious. Time is the most invisible. Time is the most hidden of all the variables. Why? Because we can't even subjectively measure it. If you're in a good mood and you close your eyes and try to count 2 minutes, maybe you'll get 2 minutes, maybe you'll get 3 minutes. If you fall asleep in the middle, you might think it's 10 minutes. If you're in the dentist's office and he's drilling, you're not going to find 2 minutes to be a short period. You'll find it to be a massively long period of time. So subjectively, time is very difficult to measure. How do we measure time? We measure time by things that we know to be regular. Regular meaning what? The sun comes up, goes down, goes up, goes down. We begin to measure things that are objective as the reservoir of information that allows us to lean on something structurally sound that we can rely upon. We know that the moon has phases. We know that it has a new moon and it's kind of, you can't see it. And then there's a full moon and it's very bright and big and glorious. All these things are the basis for measuring time. In the markets, time is the basis of winning. Buying at the right time, selling at the right time is all you really need to know. You don't even have to know the price if you get the time right. If you buy just before the market's going to go up, even if you're buying and you don't even know what the price is, and then you sell at the exact moment that it makes its high, you make the maximum amount of money. So timing is everything. Everybody knows this. So how do we get to it? How do we measure time? Well, it turns out there are rhythms in life, and there are rhythms in one's human body. You know, you have a 25-hour circadian rhythm. We have clearly got rhythms of growth and development of, you know, babies and then and then teenagers and such. And there are patterns of physiological patterns that change and develop, but they're very reliable. Doctors wouldn't be able to do much if they weren't reliable. Okay. And so the same thing with the markets. It grows. It starts small. It grows through phases of development. Those phases are measurable, and those phases can be quantified. And once they're quantified, you have a way of understanding what will come next, in the same way that, you know, a teenager now becomes an adult and takes on different shape and form and responsibility. So what I do, and what we've been doing, and where I've learned this, by the way, was from a group, a tradition, as it were, of people who have been mastering the markets on the basis of time. I studied with a man in the 1980s by the name of Jerry Boehmring. Dr. Boehmring was a chemist in California. And he had a pharmacy, he and his wife was a nurse. And so he sold his pharmacy and started trading based upon the work of W.D. Gann. You've heard of W.D. Gann?
Yes, Gann cycles.
Okay.
Mm-hmm.
Well, Gann actually somehow figured it out. He lived in the early 1900s. He was measured, I believe, by Ticker magazine at one time, and they sat with him and watched him trade for a month, and he made like 91% winning trades, and a tremendous amount of money.
Hold 1 second. If you could explain Gann cycles and Gann as well with this, it'd be great, and to enlighten the audience who aren't familiar with them.
Okay. Gann basically was interested in seeing the mathematics of how markets move. He talked about time and price and the balance between time and price. And he used, he drew a picture of a square. And if the market, and then you have a diagonal of the square. So if you're above the diagonal of the square, he said the market's in a bullish position. When it breaks below the diagonal or the 45-degree angle, the market's moving into a bearish position. He also said, he used a famous aphorism, was, when time meets price, change is imminent. When time meets price, change is imminent. And what did he mean by that? When the time runs out, the market will reverse. Every cycle has a duration. If it's 20-day cycle, after 20 days, it's going to change direction. It may go up for 10 and down for 10, or it may go up for 15 and down for 5. But when it reaches that point where it's about to, where the time runs out, just like the hourglass, you know, then the markets will change direction. And so the sands of time run the markets. And how do we know that? Because they repeat. The best, you know, I'm going to make it real simple. I have a lot to say, but if you wanted to look at the one cycle that's kind of the most generally reliable in the stock market is the 60-year cycle. And the 60-year cycle is made of 3 20-year cycles. And how do we know they're real? Well, just look at the data, okay? You go back to 1942. April of 1942 was a major low in the stock market. It was right after the, you know, Pearl Harbor event in December of 1941, and the market crashed for about 4 months, and then that was the end of it. Then it rallied from there on, never reached that level again. June of 1962, 20 years and 2 months later, the market makes a major low, right around the Cuban Missile Crisis low. In 1962, it was 20 years and 2 months later. 20 years and 2 months later, August 9th of 1982, major low. Didn't look back after that. It went up into 1987 without snickering. 20 years and 2 months later, October 10th, 2002, market makes a major low. It went up until 2007, another 5-year rally before it had a break, and then it crashed. And then recently, October of 2022, when everybody was bearish, the world is coming to an end, recession is around the corner, inflation is absolutely going to go through the roof, the market bottoms, goes up, and everybody's wrong, and it rallied and rallied and rallied and rallied. 20 years, 2 months. But it turns out the one that's the most repetitive is 3 cycles of 20. It's a 60-year cycle. And if you look closely at the really big picture, and I look at the big picture because the big picture contains the small picture. And if you're trying to trade in the short term and you don't know the big picture, you're going to be right for a long time, and then you're going to get murdered because you missed a tsunami that was headed your way for the last 5 years, and finally it came. So you need to know the big. That was one of Gann's principles. You start with the monthly data, and then look at weekly data, and then look at daily data, and then look at 10-minute bar charts, 1-minute bar charts, 1-second bar charts, and now microseconds. Whatever they do, the institutions have fun with, and they make a lot of money. So the bottom line is, yes, the 60-year cycle has been repeating forever and ever and ever. Okay. The most recent iteration, we saw the low in 2009, right? March of 2009 in the Dow and the S&P. It lines up with 1949. 1949, 60 years earlier. Okay. Now, what happened after 1949 was the market rallied. And how long did it rally? It rallied all the way to 1966. It went up 17 years. What is 17 plus 2009? 2026. So is the market going to crash? No. It's not ready. It's just not ready. The baby's not ready. That's it. Okay. Time dominates everything.
Wow.
I made a forecast last year, when everybody was worried about the market. I said, well, if you look at the repetitions of the 60-year cycle, it's been 90% repeating day by day for the last 2.5 years. Think about that. This huge period of time is repeating almost day by day for years. How can that happen? How can anything repeat almost day by day for 400 trading days? This is why people don't do cycles. They can't imagine history actually repeating. They don't know why it would repeat. Those people that lived 60 years ago are gone. Those traders don't exist anymore. The reason I'm able to do what I do and that the professionals listen to me is because I accepted the reality that history does repeat. And once you begin to accept that and look for where it is repeating, you have a huge advantage because it does repeat. I have a bunch of charts I can show you, and I'm going to show you examples of history repeating. And I teach this. This is also what I'm doing. I'm teaching this course on it, forecasting course.
This is fascinating. I have to interject. This is absolutely fascinating. I am so excited to be speaking with you today. I am excited to go below the surface and look at the market internals using your mathematical principles, looking at the Gann cycles, the SEP cycles that you have. We live in cycles. I talk about this all the time. Business cycles, economic cycles, market cycles. We're always repeating. Cycles are based on human emotion, and we're constantly in these cycles. It's about pattern recognition, and that's exactly what you do, Allen. You're recognizing these patterns. We need to be able to distinguish signal from noise, and that's what you're here to show us. because you've been doing this since, I'm sorry to say, if you've been doing this too long, you've been doing it for 4 decades. That's a long time. And you've seen a lot, you've experienced a lot of bear markets through that time period, early 80s till now. You know, you had the 2008, 2009, you had the 2000, you know, and you obviously lived through the stagflationary period during that time. You've seen a lot. We're so excited to pick your brain and get to the bottom of all this and understanding these cycles and how we can use them to maximize our trades, minimize our risk. And that's the goal. That's ultimately the goal. You know, we want ultimate risk management tool. You know, like you mentioned, weather, you know, they forecast, you know, meteorologists are here to forecast, you know, their accuracy is not 100% because like you said, nothing in the natural world is a straight line or 100%. There are no absolutes. There's always that gray area. So, and economists do the same. They take all the data and they try to create economic models based on that to forecast as well. So that's what you are. You're a market technician utilizing all these amazing techniques to help forecast where we're headed. So I am dying to know if October was this cycle low. That's a big question that goes on. You gave us great examples. 1942, 1962, 1982, 2002, 2022. Wow, they all match. And so was October our near term low? Is that what you're foreseeing based on that cycle? And what are your thoughts on the current market? And where do you foresee us going in the next 6, 12, 18, 2 years, next few years?
The question is good. The answer is yes. October was a major low in the stock market. And it is likely that the 20-year cycle will do what it always does, which is it'll make a major bottom and the bottom will hold for a long, long time. Okay. Now, basically my forecast, by the way, I have it on the YouTube. Earlier in the year, I did a yearly forecast and stuff.
Awesome. We're going to link all that in the description so everyone can check out your channel, which is awesome.
Thank you. The fun part is that this is so, you understand how much fun this is?
This is so much fun. I'm so excited. And I thank a subscriber of mine who mentioned you. And they said, you got to have Allen on. I checked out your channel and your website, and I'm going to link all that for everyone. I was blown away. I was so excited for today to talk to you. You're amazing. It's exciting.
So yeah, the 20-year cycle is there. There's also a 30-year. And so the 60-year cycle is actually, basically it's 2 30s, 30 and 30 is 60, and 3 20s. Okay. Now, the 60-year cycle is it's a driver of the bigger trends. And it has been, and you can see it from 2009, market's gone up, right? And from 2049, it's gone up. Now, what I'm looking for is a similar pattern to what happened in the 60s. Okay. You look at 1962, which was 60 years before 2022, last year, the market did the exact same thing. And I have a picture of it. I'll show it in a minute.
Yes.
Yeah, I've got a lot of charts.
Okay, perfect. We're so excited to have these great visuals. Let's see. There you go. You should be able to share all you want.
Okay, cool.
We're so excited for you to give us these charts to speak from. I know you on your website, it says, time is more important than price because history repeats. Love that quote.
Yeah, it's true.
And time is 4D.
4-dimensional. Yes.
4-dimensional. We're going to enter the 4th dimension today.
What you see here, this point here, you can see the cursor moving around?
Yes.
That was the beginning of 2022, January of 2022. And the gray was 1961 going into January of 1962. And that, you see how closely they were following each other?
Yes.
I mean, is this like ridiculous or what?
It's amazing. So could you tell us what CE and CS stand for?
The CE, and where's the CE and CS?
Right on the top, the left side.
Oh, that's just start and end.
Oh,
no,
okay.
CS is just the
Oh,
beginning of
okay.
the data and
Great.
the end of the data. And then this is what it did next. This was the low in July of 1962, and we had a low.
Dow Jones. That's the Dow Jones, the blue.
Yeah, Dow Jones Industrial Average. We had a low in July of 2022. Then we ran up in August, and then we came back down into October, and then we took off. That was the rally. This was the October low.
Mm-hmm.
Now we're just looking at the 1960s.
Wow.
This was our October low, and what has happened since. We haven't gotten away from it. It's still there. It's repeating yet on and on. Now, what we're talking about, 400 trading days in the prior chart, 200 more, that's 600 trading days. That's almost 3 years. The last 3 years have been almost identical. And if you go back to 2009, it's not always identical, but it's usually 60 years. Sometimes it shrinks to about 59 and a half years. Then it expands a little bit. I'll explain why, but there is basically the 60-year pattern is there. That's a major thing. So if you look at the 1960s, what happened in the 1960s was you had a high in 1966. It was right at the beginning of 60. So it was late 65 that the market started to top out. And then you had a high in 1969, January of 69. And then you had the major deal was in January of 1973, and then 73 and 74 was this massive 50% bear market. It went from roughly 1,000 on the Dow to 570. Now we're at 36,000. But the point was the market made a rally into the middle 1960s. And then it comes down once and it went up again. And then it came down twice and it went up again. And then from 1973, you finally had a crash that's, huge. And that crash that's huge didn't recoup right away. From 1973 all the way to 1982, the market stayed down. It had a big rally, 77, and then a rally in 75. It came back down, but it never reached that pinnacle again of 1973, and it never reached the low of 1974 either. But it went between 1973 and 1982. I believe you're looking at the next 20 years.
Wow.
You're looking at the next 20 years. The market should go up until the end of next year.
Okay.
Till the election cycle high of around the election of November of 2024. And there are many things that I'll show a few of the patterns that are repeating shorter term. But the main driver is this 60-year influence. And 1974 was the major low. And where would that show up now? 60 plus 74 is what? It would be 2034. 2034 is 11 years from now. So the market's going to go up a little bit higher, and then the weakness starts to come in. The high in 1966 may come in 65 this time. There were reasons to think that. After the election of next year, the market could begin to show what the fundamentals have been saying for months now. We're looking at a recession coming. We're looking at a bear market, but it's not going to turn around and die until that last high, which comes out somewhere around 2032 or 2033. And then the governmental influences, the printing money approach, the whole economic, monetary approach to economy, it's not going to be effective. They won't be able to whip a dead horse back to life anymore. And that will be the time when everybody's been worried about, when things kind of really, really get nasty. But until then, you can expect to see a big battle continuing. On the one side, the economics is getting weaker. There's ultimately more of an imbalance in society. There's more of an imbalance financially. the interest rates are likely to continue to rise, and we will have something like the 60s and 70s, the stagflation tendency, which others have talked about. Ray Dalio talked about it. You know, it's probably headed in that direction, where interest rates are high and the economy is sluggish at the same time. And consequently, people are not going to want to put money in the stock market. Why would you put money in the stock market when you can get 6% or 7% or some ridiculous thing in the bank?
Or
right?
T-bills.
When plus T-bills. And so, like, think about the return to risk ratio. It gets silly. I mean, it's like, why would one, particularly if you're older, you know, if you're 20 and you want to have fun with the market and make money, you know, take more, you're less risk averse. But if you're 60 years old or 55 years old or something, why would you want to go for 9% a year, which you might not even get in the future, because it is probably the case that the market won't go up that much more, okay? And you can get 6% or 5.5% right now, probably get 6 or 7% soon after in the bank, you know. So that will pull the demand out of the market. The people will start putting money into fixed income. And you say, but what about inflation? You're not going to beat inflation with the stock market if it doesn't go up, right? So it's not a positive. It's not a positive.
So just to stop you right there. So you think, okay, 2034 it's exactly 60 years from 1974, you think will be the next major low. So between now, we're in 2023 till 2034, the next 11 years. Do you see us being an excellent points? All your points are excellent. I love this. Saying how we can have more, we can, you know, T-bills, we have money. Money actually can have a return without having risk. We have risk-free rates, you know, 5.5 and up, and higher for longer seems very likely. Do you think the market will be a sideways market and we're going to bounce around a certain range?
I think it'll be a range, and the range will be higher on the upside than it has been, and about 30% lower, 30 to 35% lower after the highs come in. So I think we'll see 1 or 2 or 3, at least 30% corrections over the next 11 years, where the first one could start after this 2024 election. 2025, 2026, into 2027, we're likely to see a repetition of the bear market of 2000, 2001, and 2002, which, depending upon which index, the NASDAQ was down 80%, the Dow was only down about 32% or something. So it depends what you're in, which stocks you're actually purchasing. But until the end of next year, I think you're safe, except that there's still a tendency right at the moment between now and next March, there's likely to be at least one fairly sharp decline. It could be starting immediately. If you watch my YouTube, I've been saying it's either going to happen in October or it'll happen December, January, February of 2024. One of the two is likely to be a bit, 20 to 25% decline, and it'll happen fairly quickly. So until next April, the market's going to go up probably a bit more by the end of the year, and then come down hard either before the end of October, and then it would rally to the end of the year, or it will not have a big decline in October and go up until the end of November, like November 27th comes out as a high point for one of the major cycles. So starting in December and January and February of next year, we could see nastiness, the first correction that has some meaning that we haven't had anything like since 2022. And then most of 2024 is going to be boring. It'll try to go back up just like it did in the year 2000. You know, you had a high in January, the S&P made a secondary high in March. It shot down in April. There was one day, I think it was April 14th, that it fell a huge amount in one day. And then it went sideways, 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 boring, boring, boring until September 1st. Then it came down and up into the November area, and then it started to fall. And then in 2001, you had the big thing. You had a big thing, which lined up with the 9/11 event. And that will line up with 2025. So 2025 will be like 2001. 2026 will be like 2002. Okay. And life goes on. So it's about a 24-year cycle, right?
Wow.
And that's kind of the next 3 or 4 year forecast. And it isn't that much different than the 60-year cycle repeating either, except the high comes in a little bit earlier than it did in 1966. Okay, so that's my thinking on the Dow and the S&P.
Wow. And then NASDAQ?
Yeah, the NASDAQ will outperform in both directions. It'll be much more nasty on the decline, and it'll be much more bullish on any rallies. And they're also faster. They tend to be more explosive. It's the nature of the NASDAQ to have that internal volatility, because tech companies tend to be more attractive. They tend to be more sexy than.
They're sexier stocks. I always say that as well. They're a very sexy group over there. So yeah, they attract people, and then they scare them out pretty quickly as well when it's so volatile.
Exactly.
So people they run both ways on that. So okay, so 2026-ish, we're going to look at a new low. When you say new low, do you think it could be lower than last October?
Yes. Yes. The reason is that even though the 20-year cycle came in and the 20-year cycle is real, there are other cycles in the market that are coming in this next period where you could get more dramatic decline, and not much more. I'm thinking 3,200 on the S&P or 3,000. Okay. Before all is said and done, by the 2034 low, which is the final one, I'm looking at least 2,000 on the S&P, maybe 1,800 on the S&P.
Wow.
So we lose a lot.
Yeah. So, I mean, we know that debt to GDP is up over 119% and rising. The government's been printing money. We've been using this Keynesian economics that you think that government stimulus is how we stimulate the economy. And so there's so much of that going on, devaluation of the currency. We have inflation. Inflation is entrenched at this point. We see it reaccelerating, and higher prices across the board, higher for longer. Lot of issues, a lot of headwinds with that. You think that we know it's a slower cycle this time. You know, it tends to be more income driven. So you think that we're probably, even though everyone's saying housing's going to crash and all this stuff's going to happen, you think it's probably going to be delayed. It's going to be pushed out, and we're probably going to be holding on. It's going to be difficult times up, and there'll be a lot of cyclical bears and, you know, declines. But it'll be like 2034 where maybe this all comes to a head and all this debt really becomes unsustainable.
That's right. And I'm going to go back to the super big picture here, okay?
Please.
Look at the 1974 low. So what's 60 years before that?
Are you asking me questions? I don't want to interrupt you. I'm just letting you speak. If you're asking me questions, I'll start answering.
No, it's okay. I mean, I'm just saying for the viewers just to think about it.
Just think about it. You'll answer. I'll have you question and answer.
60 years before that was 1914. And that was also a major low in the stock market. Now I'm going to bring your attention to something else. There's actually a 314-year cycle.
Love it.
In history. And you know what happened in 1720 was the famous tulip explosion.
Yes, the euphoria. Yes. I love that.
And so 1720 plus 314 years comes out as 2034, the same exact year.
Wow. This is amazing.
Yeah.
They all come together.
Amazing.
This is
they all come together. So these are important influences that are running in the market, and they've been there forever. You see, when you start seeing the bigger ones, some of these larger cycles, and you look at the events in history, you begin to recognize the intelligence of this massively incredible system that's happening out there. You know, we live our lives, we do this, we do that, take care of the kids, we go to the store, you know, that's what we get. But when you start looking at the trends of history, you begin to see patterns of repetition that are mind-bogglingly interesting. Okay. So this 120-year cycle, where does it come from? And why do these emotions repeat? You mentioned that the emotions are the basis of why people make decisions. People in the stock market, it's basically driven by
emotion.
Emotion. Yeah, people are excited about wanting to buy something, or they're frightened and they want to sell. So, greed and fear, and just just general buoyancy. I'm happy. I want that expansive value of like I think I can make a lot of money. That kind of feeling is what drives people. And then when things are not working, they shrivel up and they get oh my God, what's going on? Oh, and that's all repeating. Why? Because why does it repeat? This is going to get to one of your later questions. It has something to do with the cycles of nature. That human beings are not independent of nature. They're not independent of the forces that make the trees grow and that the leaves go and then the leaves fall and then there are seasons and there are seasons and there are seasons. The same thing happens with people. Everybody's got some sensitivity to the forces of nature, except they don't know it because they're not seeing the collective. They're not seeing what other people are feeling. I have a chiropractic friend of mine who was telling me, I went in there, he says, I had 8 people today who all had liver issues. They all came in with liver issues. It's like today the liver was on target, Another day it was something else. There's a collective group goes through things together. And that's what the market is.
Collective consciousness.
Exactly. The market is the collective consciousness of all the people involved in it.
Amazing. I love this. It's so cool.
I can tell you a story. I don't want to get off track here, but
I love it. Please go off track. This is amazing. I'm into energy and I love talking about it because this is all related. We're all part of nature and one, and everything's all interrelated with all moving parts. So please go on.
Okay. So this was 1987, and I was betraying my age, but I was trading, and at those days used to have a brokerage house, and I was living in a small town. So the broker's across the street in a building. So I went across the street to have lunch. Prior to that, I had bought some puts on the S&P on January 9th, 1987. I thought it would go down. And my low point, my cycle low, was January 23rd, right? Well, it turns out January 10th, the market went up. January 11th, the market went up. It's like it didn't do what I wanted it to do. And by the time it was like the 15th of January, the puts were almost worthless and I had given up on them. But I didn't have any particular connection. Then the morning of the 23rd of January, which was the day the puts were supposed to expire, and the day where my cycle low came in, I was sitting and having lunch across the street from the broker at about noon. And all of a sudden, out of the blue, for no reason, I had this incredible wave of happiness, a feeling of relief and joy, and it wasn't the food that was causing it. It turns out during that half hour that I was eating lunch, the market fell 124 points, which back then was a lot of points.
Oh, yeah.
My puts ended up doubling. And I walked out. But my point was, I was connected to the market. I was connected to the psychology and the emotions, not of me, but of everybody else that was in the market. So when you trade the markets, you're connected to the market itself. It's almost like a physical body that you're connected to. And it's more meaningful when you put your money on it. If you don't have your money in there, it's not the same. If you paper trade and do it abstractly, it's not the same. When your money is in there, your brain is no longer exactly the same brain anymore.
Yeah, you got to have skin in the game, right?
You have to have skin in the game and you feel it, okay? So that's why trading oftentimes is difficult for people, because they're fighting against the collective. And usually the group is wrong. Most of the time, the group in the middle, when the market's going toward an extreme high, everybody's bullish, and that's the time to get out. When the market's going toward an extreme low, everybody's worried and bearish, and that's the time to buy, like it was last year. Okay. So the reality is when you're trading the market, you're physically connected to the collection, to the collective consciousness. So where does this collective consciousness, what affects it? And this is where we're going to get to the thing about astrology. Okay. There are influences that affect everybody. They don't affect everybody exactly the same way, but as an aggregate, as a group, they do have a collective effect on the psychology of a lot of people at the same moment, and they create actions in the markets. I can show you numerous examples of when the moon is in a certain position, the market goes up. When the moon, the new moon, full moon thing. How many people know that when you buy on a full moon, if you bought the S&P on the close of a day where it has a full moon, and you go for a modicum, I think it's $1,000 S&P profit, it wins a very large percentage of the trades. If you buy on a full moon, it has a tendency to be more bullish. Not statistically likely, but it happens.
Wow.
And I can show it back over the last 20 years. I'll give you the statistics on it.
Wow.
Basically, that's just, and what did I do? I measured every conceivable cycle combination. When Mars is in this position and Venus is in that position, Jupiter is in that position, the sun is in that position, what happens? And the computer goes through all those combinations and it finds the ones that are reliable. So we know about seasonality, for example. We know that, okay, there's a very high probability that the market will go up certain days of the year or certain months of the year. And the two notorious worst months of the year are September and October, historically, okay? And the two best months of the year are generally in April and May, interestingly enough, okay? Now, what's also interesting about that is, why does that happen? And you probably could find a number of reasons why that seems to be the logic. But the real answer, the real reason is that in the astrological system, the position of the sun is at its weakest point, October 28th every year. As it approaches its weakest point, people have less courage. The feeling level is a little less confident. And as it emerges from its lowest point towards its highest point, which turns out to be April 28th or something, April 26th, people tend to gain more conviction. They tend to gain more confidence. They tend to gain more optimism. And so you've heard the expression, sell in May and walk away. It's exactly in line with the cycles of the seasonal. The seasons, the sun. The astrological development of the sun goes from its weakest point in October to its strongest point early May, and then back again. Okay.
Wow.
The same thing with the election cycle. There's a 4-year election cycle. Everybody knows about it. If you buy at the midpoint of the election, if you buy around the midterm election, halfway between the two presidential elections, and you hold it until the next presidential election, you generally make quite a bit of money. And for those who don't know, you know the average return in the 2-year window from the midterm election to the next election is 50%.
Wow.
50. So what is it doing during the 2 years? I know. What is it doing during the 2 years that, from the new election until the midterm? It tends to have more trouble. It doesn't necessarily go down, but it doesn't necessarily do much. So just a simple thing. So if you buy at the midterm election and then buy every October in those 2 years and hold from October to May in the 3rd year and October to May in the 4th year, you're going to make more money than you would in the rest of the time, and you might as well go on vacation.
Well, let me add to your theory. Well, last October was the low, right? The cycle low. So midterms were November of 2022, correct?
Right.
And then there you go. If you bought right after the October low and to the election, I think you would have been pretty good. I think if you bought around that October low, it was great. So it coincides exactly with this theory.
Yeah, it's happening yet again. See, the whole thing is to recognize that the cycles of nature are bigger than us. You know, we have like a 25-hour circadian rhythm in the body. You know, we wake up in the morning, it's a new day. The sun rises, the day is a fresh beginning, a new beginning, a new beginning. But nature has bigger cycles, bigger seasons. It goes through these normal seasons. We talk about the 4 seasons, winter, spring, fall, and all that. 3 months, 3 months, 3 months. But there are bigger seasons that are invisible. And they're picked up by the economists. You've heard of the Contradiev cycle, the 52-year Contradiev cycle. And basically, Contradiev, who was a Russian economist, he realized that this similar type thing is 13 years is like winter, and 13 years is like summer, and 13 years is like fall. And so if you see these bigger seasons, as well as the smaller seasons, and you line up the up phases in the bigger cycles with the up phases in the smaller cycles, you're maximizing the efficiency of your investments. And that's what I do, and that's what I teach. How to locate where the cycles are. So if several of them are coming together in the same direction, you get a much more immediate and much more satisfying and bigger move than when one cycle is in the winter and the other one's in the summer, and they're fighting each other. And when they're fighting each other, you get these congestion areas where the market goes nowhere, where it goes sideways, you see? Until it's called wave mechanics in physics. When a bunch of waves are moving in the same direction, they create a big wave. If you have 6 different waves of different sizes and you put them together, then they tend to cancel out some of the time. But every once in a while, you get all 6 of them moving together in the same direction, and you get a big move up. And every once in a while, you get all 6 of them moving together in the down direction, and you get a crash. And most of the time, they're fighting each other because they have different rhythms. The up in this one is the middle of a down in that one, like that. And that's all it comes down to. And it's very, very simple. But what do you need to do? You need to locate the individual rhythms and keep track of them, keep track of these seasons, and then continue to add them together. How many are up and how many are down right now? Okay, if there are 6 cycles and 3 of them are up and 3 of them are down, the net result is like 0, so nothing's going to happen. If 4 of them are down and 2 of them are up, it's a net -2, you'll get some sort of a down move. It's that simple. But people don't know where those waves are, and they don't have a way of combining them, and so they don't really have an understanding of what the net composite wave, the net resultant will be. This is all it is. It's just keeping track of the waves, as it were. You learn how to surf. It's just surfing.
You're surfing the market. I know you have innovative, time-tested market wave patterns. And I love what you mentioned. I read this on your website, and how they're most accurately forecast the future high and low points in the markets more than the traditional cycle theory. So what I'd like you to do, if you could please tell us how your system differs from the traditional cycle theory, and then if you could please show us what you mean.
Okay, good. Okay, the difference is sine waves. You see, when people talk about cycles in the world, they think of a cycle as a sine wave. A sine wave, and it comes out of radio waves. The waves that we know in the world. Well, you look at the ocean, right? You see waves in the ocean. But most people, when they think of waves, they think of radio waves. They think of waves that go up and then down and then up and then down. And they smoothly go up for a while, and then they come down the same amount, and then they go up and then they go down the same amount. And the initial description of radio waves was accurately mathematically calculable. As you mentioned, you want to separate the signal from the noise, right? So how do you get the signal to be separate from the noise? Well, what they did, and they still do, is they did a thing called Fourier analysis. It's a mathematical procedure where if you take a complicated looking wave, like the stock market is a complicated looking wave. It's up, down, up, high, this way, nothing, and then big round, jumpy, sideways jump. It's a complicated looking wave. It's not some smooth thing, right? Well, if you take a complicated looking wave in radio wave mechanics, you can do a Fourier decomposition, and any wave, as long as it's a continuous wave, even if it's sharp at points, can be decomposed into a sum of sine waves. You can find one sine wave moving at this rate, another one moving faster, another one moving really, 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 really slow. Add them together, and you can get, when you add them together, you get a picture of the compound wave, the complex wave, the composite wave, okay? That composite wave is what we call reality. That composite wave is what we call the stock market. But the assumption that's being made is that the waves are sine waves, that the component waves that are inside of this ocean of waves, they're sine waves. The difference between my stuff and that is the waves are not sine waves. They're not that regular like that. Instead of going up for 10 units and down for 10 units, they may go up for 8 and down for 2, and up for 8 and down for 2, and up for 8 and down for 2. Another one may go up for 6 and down for 4, up for 6 and down for 4, up for 6. And when you add those together, you get a much more accurate summation. You get a much more accurate model. You get a much more accurate forecast than if you'd use the traditional ways. There are guys who do this Fourier decomposition and another thing they call spectral decomposition. They're modern physics ideas and modern wave mechanical ideas and even quantum mechanical ideas. But all those things are basically assuming the waves to be smooth, continuous sine waves. That's the difference. And when you do it that way, you get a better model. You get a more accurate forecast. Okay.
Wow, that's so awesome. So excited. Show us, please.
All right. So now I'm going to show you. First of all, I want to show you the. Can you see this chart here?
Yes, the Dow Jones 1930 to 2008.
Okay. Did you see? Can you tell which one's which?
Which one's which for what? What's what? What are the two that I have to choose from?
The two. One of them is the graph of 1930 stock market. The other one is the graph of the 2008 stock market.
Wow.
They look.
I'm going to have to go with the guess. Now you asked me a question. Let's see. Well, I'm assuming 1930 was worse than 2008. So I would say 2008 is the green one.
That's right. That's right. But do you see how similar?
Yay. I get an A with Professor Allen today.
Professor Allen. So, okay, so here we go. We're up and we're down together. They're up and down together. You see this low comes in the same place?
Yes.
That high came in almost in the exact same place. The low came in within about 2 weeks of each other. The fact is that history repeats. And the reason what I do is, the other approach, which is taking the market apart, putting it back together in terms of waves, is called the synthetic approach. It's called the analytic approach. It's basically taking a thing apart into parts and putting them back together. This is what I call the synthetic approach, which is locating the combinations that already exist in the market that have happened already and finding where they're going to happen again. Then you don't need to separate it out and put them back together. This is an example of a 78-year interval of time between 1930 and 2008 where the market repeated. And why did I pick the 78 years?
Wow. That's
because that is a piece of a bigger cycle, which we're going to get, what 78 times 2 is 156. It turns out to be 78 and a half years is half of 157. 157 is half of the 314-year cycle that we're talking about. And that 314-year cycle is a real cycle in nature. And I went back all the way to the Roman Empire, and I found patterns.
I love it.
And so I knew that this is a real cycle and that it was likely to come in 2009, okay, because it came in 1932, 78 years earlier. All right, so the trick is locating the interval. I'm going to show you some. You see this picture here?
Crude oil. Yes.
That's crude oil, and this is the year 2014 is at the beginning, and 2017 is at the end. So you're looking at 3 years of time, and the dark blue is 2014 through 2017. The light blue is 17 years earlier. The light blue is 17 years earlier. So 1997 through the year 2000. And look at how similar they are.
Wow.
If somebody told you that crude oil was going to repeat for the next 3 years what it did 17 years ago, you could make more money than you could count. Okay? If you knew that this blue line was going to follow the light blue happened 17 years ago, and you see that the light blue keeps going down, and let's say you went short over here, okay? Ordinarily, you might think, well, I don't know what'll happen, but I'm sure it'll stay short a while and see what happens. And maybe you'll get out of it here, maybe you wouldn't. But if you knew with conviction that this trend was going to last for 1.5 years, when it came up here and the light blue is turned down, you'd be going short at this point, because the light blue trend has been hanging on to it, and it went up as it was supposed to, and the present market went up as it's supposed to. So when the light blue turned down, and maybe you get a sell signal on one of your short-term systems, you would hold on to that for 6 months rather than for 3 days or 3 weeks, because the anticipated path is repeating and has been repeating. And then when it got to the low, we're over here, and you see that the blue line is starting to turn back up. This isn't a moving average. This isn't something measuring what's happening in the recent past. This is something measuring that happened 17 years earlier.
Wow.
And that continues. And then for the next 1.5 years, it went up. And you see, you could even follow the path on the way up. And a good deal of it was repeating very, very closely. Okay. Here's another example. This was the red line here.
The Gulf War, yeah.
The Gulf War. The Gulf War is in green. The Ukraine War is in red. This was where the Ukraine War started in February of 2022. And there was a sharp rally in the market from February until March, and then it came down. This is the price of crude oil. But do you see what happened before that? This is from 0 to 200. This is roughly 10 months. 10 months before that, the Ukraine war pattern was imitating the Gulf oil war pattern from 2003. So a 19-year cycle was repeating in nature, and that war pattern did almost exactly the same thing. It had this dip here, and had a huge rally, and then they started to go down together and up together. So it has a tendency to repeat huge spans of time. And if you can figure out, and we do, which chunk of time is repeating, it's not an accident that there's a war cycle and that war cycle relates to 19 years, okay? Because the wars have shown up in association with this 19-year rhythm historically. The Gulf War #1, Gulf War #2, the World War II, all of them, they're in line with the rhythm, okay? And if you find that rhythm, you have a pretty good handle on what crude oil is going to do. This is another example.
Wow, yeah, I believe we're entering a commodity super cycle, or a type of a secular bull market in commodities right now, and I'm sure you can match that up with some market patterns as well.
Absolutely.
And I was just going to ask you about gold. So you read my mind. I guess our collective consciousness is in sync, because I was going to say I'm dying to see what happens with gold.
Okay, so this is my story with gold. The likelihood is gold is going to probably rally until late October, and then it's going to come down into next April, and then most of next year it'll go up pretty good. It'll go up, make new highs, okay? But the big picture on gold is not bullish, okay? Wow. It probably will have there's a deflationary pattern coming, which will be affecting the stock market until 2027. And except for next year, where gold probably will rally, it'll pull gold down with it, okay? Gold will not be, the fear trade won't be there. It will be too slow and too sluggish. It won't be just some war threat or something like that would trigger a gold rally.
Do you think it's because
Yeah.
of Bitcoin? Do you think Bitcoin might have taken its place as a safer asset in like stagflationary times?
Yeah, probably. When but most likely after the next low. I think that everything's going to fall together in 2025, 2026. And then after that, you'll see explosions in Bitcoin, explosions in gold, much, much better. But patience is the key to this whole game.
Patience. I love that word. That's it.
You need to wait for the time, you know. You can't fight the time. If it's not ready, it's not ready. I don't care what you do to it.
Well, you know what? Right now we're getting paid. I actually just tweeted that today. We're getting paid to wait. I mean, we're at least getting 5.5, like you said before, 5.5 up to 6% in money market and T-bills. You can do ladders on T-bills, short term, of course, the 4-week ones. And, you can be paid to remain liquid.
Absolutely true. And that's the reality of it. The reality of it is that if one has the attitude of being a little bit more defensive and a little bit more conservative with one's spending and continues to think in terms of fixed income and reliable, government assets, you're going to be in a position to weather the storm. But if you chase the stock market when the market doesn't really want to go anywhere, you're going to wind up suffering the consequences. So this isn't a great time for speculative fever, even though everybody's speculative. Now they have options that expire every day,
I know. It's crazy. The zero DTE, absolutely. I think of Kenny Rogers in that song. Got to know when to hold them, when to fold them, when to walk away. So you got to know the time, right? Timing is everything.
Timing is everything. It's all about time. And is that cool or what?
I love your charts. They're awesome.
This is September 3rd of 2010, lining up with April 28th of 2022. It's 11 2/3 year cycle in the stock market. This is almost a whole year. Look at how similar it is.
Wow.
Is that mind-blowing or what?
That's so fascinating. How do you find these times that match? Are
that's what we teach how to do. There are ways to do it. There are ways that you can start from where we are and prove that a particular interval is repeating because you find how it's related to now. Okay, not everything pattern recognition is useful, and a lot of people do pattern recognition, but you don't know which patterns are going to continue.
Exactly.
Okay? That's what we teach, how to tell the difference between the ones that look the same and the ones that are the same and that will continue. And if they continue for a while, if you're in the market here and the blue line is the guide, and the red line is the real market. If you go long here, to hold it until this area. Okay. And then the blue starts to collapse. As long as the connection is there, you'd think about getting short somewhere in here. May not get the high, but you'll think in terms of a short position is more profitable than a long position. And you'll know that it's likely to continue for months. Each of these 10 is 2 weeks. So this is like 1 month, 2 months. So you have 2.5 months where the blue thing is going down, and the red one, if it follows it, you have 2.5 months short position. Okay.
I love it. And see what your charts do. Your charts give confidence. They help give conviction. A lot of people, they can say, "I feels like this is what's going to happen." But I don't know. I don't know. And I can't trust myself. But looking at these charts and seeing how these patterns are playing out, it gives you that little conviction that you need to just hold through that and look at the profits you can make. Wow.
Exactly. And that's why I use the expression trade with confidence.
Mm-hmm.
And the confidence comes from knowledge. And the knowledge comes from locating the cycles. And the knowledge of how to locate the cycles is easy, but you have to learn it. It's necessary. You have to go through a little bit of homework to do, but it's not hard. This is that same pattern, the same number of days, 2 years earlier.
Oh my gosh.
96%
correlation. Look at that.
For 400 trading days. And I'm not making this up. This is the real market. So if you know these things and you know that these patterns are real and you know where to find them, you have a huge edge over somebody who doesn't have that confidence to hold on to positions because they know the trend will continue for another year or the trend will continue for another 6 months. That's the basic idea. Let me show you. This is another one. This is 2000 to 2022, 22-year cycle. The other one was 11 and change. This one's 22. You see how the one, I don't even remember which. Oh yeah, the red is the present. This is 2022 is the red, and the year 2000 was the green. Okay, and it was really fun because I was teaching a class at that time, and it was here that the I forget the date. It was somewhere in early 2022 when the Fed raised interest rates 0.5%, and it was the first time they had raised interest rates recently by 0.5%. But then I heard on the news, which I didn't know, that the last time they did that was exactly 22 years earlier, and we were watching this cycle in the in the group, and it turns out that it was validating that not only the interest rates went up by 0.5%, but it hadn't been since then that exact event took place in real life. Wow. And that came out at the same place. So it's saying that not just the market is repeating, but actually history is repeating.
History, yeah.
Let me find some more stuff here.
I love how you utilize technical and fundamental analysis. That's awesome. I love it because it's always about being holistic. It's about incorporating everything. Everything's interrelated. So the fact that you're able to have everything correlated together, I just love it. This is fascinating.
This one is this just to show you it works even in shorter time frames. This is a 240-minute bar chart where each of the points are 4 hours, right? And so this whole thing from 0 to 360 is actually 40 trading days. Excuse me. No, excuse me. 30 trading days. This is 30 trading days intraday. And look how similar it is repeating. Intraday. This is like one day, another day, another day, another day, another day, another day. That's, again, 80% correlation over 3 months. So you could actually see it almost on the level of day trading, that a particular pattern is going to repeat. That's how exacting it can be in real life. Let me find something else that's interesting. These are all the same. Hang on. Oh, this is the mechanical. Okay, you see, this is what the computers do. You see, these are the different wave decomposition models. This is soybeans on a daily chart, and these are individual waves. The yellow one is one, the light blue one is another. There's a slow-moving red one and another slow-moving.
Oh yeah.
There are 13 waves in there. And when you add them together, you get a picture of the soybeans. And it actually works. That's the composite wave when you add them together, what it looks like.
Very cool.
Let me see. There's some other stuff. Let me find it. I wanted to show. No, it's not here. Let me see if I can find what I'm looking for.
Then you have 26 algorithms as well,
right,
built on theoretical principles. And they're not just simple curve fit to past data. And that's fascinating. So yours are unique. If you could tell us about that as well.
Okay, I'm going to show you example. I'm about to go to Zoom on my other charts.
Great. I know they accurately forecast future high and low points in the market. So interesting stuff.
Okay. All right. So here's an example of a chart on the S&P. Actually, this is on the Dow. Blow it up. You can see that, yeah?
Mm-hmm.
Okay. If you look closely, you see how there are buy and sell points along the way?
Yes.
Okay. So when the computer adds together the waves and more of them are up than down, it goes long. So it went long there and it stayed long. And a blue line is a winning trade. Okay.
Oh, yeah.
So it went long here and it got out of it. Then it went short here and it stayed short until that means more waves were
Yes,
down.
that was the probably November time period in
Yeah,
late
that was
21.
exactly November 21. And then it went long here.
Probably like October-ish, maybe.
Yeah, this was September 16th of 2022. And then it went long and then short and long. It's at the moment it's short. But I want to show you the statistics on this system, which is based on adding a bunch of waves to. Do you see how many winning trades you have in a row here?
Oh, yeah. This is your algorithm?
Yeah.
Wow.
Yeah, look at this. These are all winners. Yeah, there's a tiny loser here.
That's impressive.
But look at, and then, you on TradeStation, you can see the results. This is the strategy performance report from 1978 till 2023 on the Dow. Now, of course, you can't trade the Dow, but if you traded the equivalent, it made 64,000 points on a market that's at 34,000. And it had 55 trades, 81% winners. 96% of the long trades were winners. 27 out of 28 were winners, right? And there's nothing changing. No change. The exact same waves added together. As soon as you get more of them bullish, you go long. As soon as you get more of them bearish, the same waves have been working for 45 years. And this is what the equity curve looks like.
Oh my gosh.
Okay. And this would be year by year. 2023, it's up 1,500 points. This is on Dow points. But you see how it's been really good. It had a losing year in 05 and 06, but then back to 1990, it had 2 losing years in the last 30. And it's based on this concept of time only time. There's no measurement of momentum. There's no measurement of price. Just when more waves are turning up, you go long, and when more waves are turning down, you go short. So if you use, let's say you have 11 waves, 6 of them is enough to get more than half. So when 6 of them are up, you go buy it. And when 6 or more are down, you go short. And when 6 or more are long, you go long. That's it. That model is based on, and that works. It's proof that you can forecast, and that the forecasting is just adding together waves if you have to find the right waves. But 45 years, 96% winners on the buy side, that's better than buy and hold, because your drawdown was almost nothing. And you made money in the crash in 2008. You went short in here and you stayed long until the low. It went long.
And doesn't take into account any geopolitical, macroeconomic factors, nothing. It just uses these wave patterns.
Right. Yeah.
Wow.
It went long on March 6, 2009.
Do you look at option flows at all?
Not for this. I can. I do other things to refine the confidence level, but you really don't need, if you know where the waves are, if you know where the cycles are turning, you're going to do better than almost everybody.
This is amazing. Oh, wow. So you have 26 algorithms. This is one of them. When did you start? When did you create these algorithms? How long have you been doing these algorithms? And
since 1998.
1998. Okay. So, okay, please tell us more.
Okay. So I'll show you another thing. This is, okay, this is a price algorithm. We were looking at time. This is a price algorithm. These lines, I call it the matrix channels. The matrix is a bunch of imaginary, they're invisible force fields, call them what you want. This is like the field effect, this is like, these are like people use support and resistance lines, but these support and resistance lines do not depend upon the price of the market. These support and resistance lines are there anyway, and the market is running into them. And they're not generated by calculating the price of the market, like Fibonacci levels and moving averages. No, these are there, and the market shows up afterward. Okay. Now you see how when it runs up into a bunch of them, it tends to turn down. And but this is a Gann principle. You see this horizontal line. We call that the timing angle. Okay. So the first principle is that the market itself, when it runs into these lines, they tend to represent resistance to the direction. So, and if you look at an intraday chart, even when it hit this blue line, it actually had trouble getting through it on an intraday chart. But if you have a cluster like that, it's very hard to break through, and it didn't. It came back down. But what's really cool about it is when this timing angle goes through one of these lines, time meets price, change is imminent. That was Gann's. Look at what happened to the market. As soon as the market got up to that intersection point where the timing angle hits the blue line, it turned back down. And you see that same angle down here. The red is down there lower also. Let me change this.
Wow.
You see how these are parallel? This parallel version. So when it hit the green line here, that was this low, that time point. So it hit that high, that turn. This was a turn. And then when it hits the next one, look at that exactly. The price of the market runs into the timing angle and runs into the red line here. And as soon as they met, the market reversed and collapsed.
Wow.
And that's where we are today. This was a few minutes ago.
Oh my.
And so it called this low. It calls a lot of the pivots. It called that decline, called that low. It called, I haven't even laid out everything, but it called that high, that low, that high, that decline, that low, and that low all the way till here. Then it caught up this one, this one, this one, and it has nothing else nearby.
So as of right now, it's still in that decline.
It's still short. Yeah, it's still short. It'll stay short for a while. So that's, how you use these things. This is a price. This is another algorithm. I call it the matrix channels. Let me see what else I can show you. This is cool. Okay, this is the slide technique, I call it. The red line is the real market, and this is where it was, I don't know, whatever, 1 o'clock this afternoon, and it's right now. It's still live. Okay. Anyway, so this is the real market. This was the market exactly 4 months ago.
Oh, wow.
The blue line underneath here is what happened 4 months ago. And because the 4-month cycle is a real thing, it's actually somewhat known that there is a 4-month cycle. Look at what the market did here. It had that little double top, and what it did here. And then it goes down until here. And this is what it did 4 months ago. Then we have this bounce. That high came in right on. That low came in right on. That high came in right on. And right now we're in this sideways to down phase. And then it should go up into the 28th and another high here, maybe a little bit later. But basically there's a sideways to down phase based on the 4-month rhythm until October 16 or 17. We're in the beginning of some kind of correction. Now you can't get the magnitude of the big moves from a 4-month cycle. It's not big enough. But during the same period of time, there are other things that are going on that indicate the market may come down hard. Okay, and if it doesn't, then I'll show you what else is happening. You want to know about this thing called step cycles. Okay, so let's look at.
We want to know everything.
I know you do.
This is fascinating. I love this. Allen, your work is amazing. I really appreciate this, you taking the time to teach us, because this is brilliant.
I love teaching it. And I really want to share it because some of it, I mean, obviously I charge money also for this, but the value add is that people should know the truth.
It's always about the search for truth.
That's right. It's like, this is what's really going on, you know?
Mhm. That's what this channel, my channel, is about. It's about uncovering the truth. So this is so amazing. You're going to be episode 100, by the way. So yeah, that's a special number. I think, right?
I
And it's
think
going to
that's
be
wonderful.
the centennial, the 100. So
I love it. I
yeah,
love
and
it.
it's a magical number. And this isn't magical. This is just amazing. Well, it is magic to us because we're watching you do it and how it unfolds, but there's a science behind it all.
That's right.
And
That's right.
it's just, wow, I love this.
All right. So this is a cycle that I had found. I'm going to make it darker so you can see it. I can't go into exactly how I found it, but it's a 45-month cycle from point A here.
Yes, you were meditating one day and somehow it just came to you, right?
Well, Gan talked about 45 all the time. This is okay. Now watch this. Okay, so follow the yellow brick road here. So as I move the cursor, and I'm gonna move it over on here on this side, watch it over here. Okay. All right. You're gonna, what we want to see. We want to see if the market repeats. Okay. So point A. If I get a grip on it. Okay. Do you see what happens? We're at point A, and now I'm moving up to the next high. Do you see how there's a high over here?
Yes.
Okay, now look at what it did here. It has this little dip and a rally, right? I'm going to try to get a grip on it and slide it. And where does the rally wind up? In the right place, right? Then there's a decline back here, right?
Yes.
And you see where it goes here? We have a decline. Then a rally in the same place. Then a decline. Then a rally. Then a decline. Now we're in this business here. Now there's a slight deviation, but there was a low here. And if this continues, then the pattern will continue to drive the market higher until where? Until
you think we're going to get a drop like that?
Well, we'll get something. Here we go. We got that thing here. That would be, this date would be November 14th. And then you get the potential as a drop. But you see the 1/3 points from here to here. I put in these are 314. These are 314 bars apart. The number pi times 100.
Oh, yes.
So this is 942 bars, which turns out to be 45 months. And it's also 3 times pi times 100. And so look at what happens at the 1/3 points, because they're also telling. You see how point A here, you have this high here. You see how you have that high there. This was a minor high, but it was a high. You have a crash high here, and you have a nice high here. All of them do the same thing. From this point here down to A, you have a big break.
Yeah.
Getting a grip on this. So there we go. And exactly the same point, we have this big break here. We have a little thing, but it's a breakdown to a low here. That was a big breakdown to our low. This was the August of last year low. And that next occurrence comes out starting around the middle of November down until the end of the year. So that wouldn't speak too nicely toward the end of the year for a big crash type thing, if it does not happen now. Now, right at the moment, the Dow is still holding this trend line. Let me go back. I blew it up a little bit. You see? Right at the moment, it's just holding this trend line. If it holds that trend line, this pattern will continue. If it doesn't hold this trend line, there's one other pattern that could overtake this one, and it will go down. It'll go down into late October, and then it'll do a rally that's big. And it'll reach this upper channel eventually. you know, David, what was his name? The one who called for the melt up.
Oh, that's David. He was on the show. David
Yeah.
Hunter.
Yeah.
He's a nice
gonna
man. Yeah.
this upper line is going to get reached eventually because the momentum is in place for it already. It's going to make a new high eventually. But I'm thinking either it's going to break down right away and then go up and do it and then break down again, or it's going to hold to this path and then it'll collapse. Either way, between now and March of next year, there's a high probability of a big break. And I'm telling people right at the moment to be careful, because if it breaks this line and breaks that low, it's got at least down to at least 2,000 points before it stops, maybe more on the Dow. But remember, it's a correction. This is not the beginning of a bear market. This is not the end of the world. This is just shaking out the bulls. That's all. And it's going to shake them out either now or it's going to shake them out by the beginning of next year, January, February at the latest. And so that's just another example. I wanted to show you this step cycle thing that I had talked about. Because this is how it works. And that's not it. Where is it? Oh, here we go. Okay. This is the bonds, treasury bonds. And you're going to like this because it's a little bit different than usual stuff. But all right, you see how there's this interval. Turns out to be 268 trading days. And these are multiples of it. So each of these blue lines are separated by 268 trading days. Notice point A here is a low. Okay. And point A here is a high. Seemingly opposite, right?
Yes.
Okay. Well, watch what happens when you go forward from A here. This low takes you up to that high. That high takes you down to that low. Then you have a decline a couple of days into there. I'll get a grip on it. There we go. And you get a rally opposite. Of course, this is a high, that's a low. The whole thing, in other words, this rally on the way up is going to repeat on the way down. This move on the way
mirror.
It's a mirror, and it's going to repeat the same step cycle. The internal structure of the cycle is repeating a pattern of numbers. And here we go. So let's go to point B. Where's point B? Up here. Okay, go to point B up here. And guess where we are? At that low here.
Yeah.
So the move from A to B down was the mirror of the move in time, was the mirror of the move to A to B up. And the steps along the way repeated. Now what? Now we go to point C. Well, if there's a decline down to C,
that means it's going to go up.
You should go up the same amount of time. So let's take that over there. And look, the low on C comes out as the high on C. And then we have a rally up to D. We'd expect to see a decline. And lo and behold,
there it is.
There it is. Now, what's really fun about this, we're not done. Going to take this chart and make it a weekly chart. The same chart, I'm just going to put it in a weekly time frame so you can see the bigger picture. And then I'm going to show you this same thing has happened before. It turns out it happens every 166 weeks, which is 3 times 268 trading days. So let me find 166. The interval is 166 weeks.
Yeah, look
Okay,
at that. Look at D. D's
so
matched up.
yeah, and here's A to A. So here is A is a low here, A is a low here, A is a high here. But the
Mm.
move from A to B up here is an up move. The move from A to B here is an up move. The move from A to B down, the same amount of time, same steps. It just did it
Ah,
upside down.
yes.
Okay, so we have one occurrence, two occurrence, three occurrence. There's a fourth occurrence. So if you want to forecast what's
Mm-hmm.
going to happen next, you want to just follow the yellow brick road here. Point D is at a point where what happens?
Gonna go
This is
up.
yeah, it's going to go up. So it goes up from somewhere in this vicinity of October 27th until
And when's
May
E? May.
May 24th of 2024 is a high in the bonds. And then the next A point is February of 2025. So the picture of what it's going to do is it's making a bottom in October. It's going to rally until May, and then it's going to come down into February of 2025. Then it'll go up again into point B. Notice the move from A to B is huge. The move from A to B is huge. The move from A to B is huge. So the move from February of 2025 to January 23rd of 2026 is
Mm.
this huge rally in the bonds, which means finally we get a decline in interest rates.
Yes, exactly.
So this gives you an idea of the timing.
So it looks like the Fed policy is going to keep interest rates higher for longer until at least 25-ish per this chart.
Early 2025. They're waiting for the next election, you know.
Mm-hmm.
It'll go up into it'll rebound until May, but then it'll come back down again, which means interest rates will stay high until the election.
Mm-hmm.
After that, then they'll start to go down.
So, and I always like to talk about when if they cut rates, it's actually going to be a bad sign because it means the economy is not doing so well. And usually it's during the recession and during the difficult times that they're forced to make those major rate cuts. So when everyone's wishing for, oh, we're going to have a soft landing with rate cuts, inflation's going to come down, and I always like to say it's sort of like a fantasy land. We're going to have to pay the piper somehow and somewhere and at some point. So there's going to be probably some type of recession near term, and to work our way, this will take time.
Exactly.
We had free money, negative rates for so long.
Exactly. And it's basically telling you this is probably the timing.
Yes.
Now, what's also interesting is I have a pattern recognition program. Let me see if I can get that up to give you an idea about this. I only use this as a kind of a double check on if the computer is finding something similar, but I have to get out of the trade station and get into that. Okay, this is a program that I got years ago. It's no longer available. I think for some reason they had some legal issues with the guy who invented it. I don't know, but I still have it. So this is the Treasury bonds. The upper one is the Treasury bonds back 234 trading days. So this is 11 months back what it's done. This is the big break. Okay. And then the 2016 is a good match, right? February 28th of 2016 matches. Now you see how it's very similar to what we said. It basically goes down and then up into this is May. There's another high in September, and then it comes down again. And what's really fun about this is the same pattern, the second match, which is also 77% correlated. It does the same thing. And so look at the two of them. This is the real-time market. This was the 1996 market. And that's the 2016 market. Do you see how similar they are?
Yes.
They go up together, down together, up together until the same point, roughly, maybe a few days off, and then it comes down. This is the path of the bonds, which is in line exactly with what we found using our work. This is the computer verifying that it's a very high correlation with prior markets. This was 6.6 3/4 years ago, and this one was 27.25 years ago. And this one, which is not exactly the same, was 1994, was 29.5 years ago. So this is another tool that can be used. Once you know what you're looking for, and you know what the work is telling us, then you can see if it's confirmed by the picture on the pattern recognition. But I don't start with pattern recognition to locate these things. I start with the mathematics, find out where to look, and then we see if it fits, if it's working, like that.
That's it. You use the math first before.
Right.
And so that's how you know where to look. Because that's the question I have is, where do you find these? Where do you locate these patterns? It's pretty amazing. Does this have anything to do with the Riemannian geometry? I know that space-time curvature.
Yes, what it does, the mathematics is not complicated, by the way. It's really simple. It can't be too complicated, because nature ultimately, in order to be scale invariant, in order to operate on every time frame, it has to be a fairly simple formula, okay? But it is profound in the sense that it's not obvious. And the Riemannian geometry comes in terms of the curvature of the way the market moves in 3 or 4 dimensions. Do you remember the chart that we just looked at, where we had an A, B, C, D, E going down? We had another one. The reason that can happen is because the system is 3-dimensional, not 2-dimensional. When you put a chart up on a flat plane, on a flat surface, you just see it expressed in 2 dimensions.
Yes.
But what is a 3-dimensional system when it's in 2 dimensions? Sometimes it just means it's going around the back of the building, and then it looks like it's going down. You see? Think about the planets. Think about the planets. The moon is running around the Earth, right? You have your Earth and the moon running around. And it looks like it's a circle, right? Or an ellipse, okay? Right? But guess what? The Earth is moving. So this thing is going around that thing while that's moving. So what do you get? Instead of a circle, you're getting a spiral. And the Earth is going around the sun. So you have one spiral and another one moving like that. And then the sun is moving around the center of the galaxy.
Yes.
And so there's spirals within spirals within spirals. And what we're doing is measuring these spirals in a flat surface. So you're looking at the projection of a multidimensional system onto flat surface 2-dimensional charts. And that's where the confusion comes in.
Yes.
See, because sometimes if you're looking at it from the Earth's point of view, the motions are going to get stretched when the planet is going around the other side of the sun, and it'll get squeezed when it comes around this side of the sun. So instead of being equal in terms of the up moves being equal in time to the down moves, which they would be if you were living on the sun, if you were living at the center, but we're living on a point that's away from the center. So it distorts the way the motion really is. And that's what's being projected in real life. It's a real up move that's only 5 units and a down move that's 8. Okay. And that's why people have trouble. They're not used to the left brain. It's one of these things we're overly dependent upon linearity. Our minds are overly dependent on thinking in straight lines. And the more creative people have an easier time with this stuff, because they're not locked into the kind of rigid linear kind of framework like Euclidean geometry was the initial framework. And they used to think the world was flat years ago, and now we know the world, and then they thought the world may be curved, but people were getting their heads chopped off for that belief, And then now we go up in a spacecraft and we can see that the thing is curved visually, So ultimately, it's just a question of when the world catches up with the knowledge, This knowledge will ultimately supersede the more incorrect knowledge, whatever incorrect knowledge there is. It will be replaced by more profound insights, because the reality is that we're living in a multidimensional system.
Yes, we are.
And that's why people find it complicated. It's not really complicated. You just have to view it from the point of view, from the reference point where you really are, as opposed from an imaginary reference point. That's
Yeah, it's the way we're taught, like you said. It's like we're taught in these with straight lines and linearity. I can't say that word,
I
linearity.
know. Well, see, that's a good sign.
And so we're, it's things curve. Everything has a bend to it. There's no such thing as 100%. Like I said earlier, my son loves astrophysics, so he's studying that, and he always talks about all this. And it's just about sort of relearning and rethinking things in a different way. And like you said, it's not complicated. It seems complicated just because we don't know it. And, it's like there's that expression, everything's Greek to me, right? Well, to a Greek person, it's pretty simple, right? It's natural for them, but it's because they've been taught that. But for us, we haven't. So it seems so complicated. But yet when we learn it, it's like, oh, it all makes sense. So it's just about learning and understanding it.
Exactly. And this stuff's not really difficult. It's just a question of seeing it for the right, the right glasses, as it were.
Well, you're an excellent teacher. You're really, this is amazing. Love it.
Good. Good. So, any other points?
Yeah, the Ichimoku cloud.
Ichimoku cloud is it's a technical system that was invented by a Japanese reporter in the 1960s. I forget his name, Hokawa, I think his name was. And it's a good way to get a snapshot kind of understanding of markets and like what trend is. And what happens is there was an original system. I can put it up on TradeStation. I'll show you.
That'd be great. This has been a real treat. I love this. And then after Ichimoku, I'd love you to talk a little bit about Vedic astrology.
Oh, boy.
And I know you touched upon it earlier. If you could tell us a little more about that and how you use that to forecast the markets. If you could show us any of it, that would be amazing.
Okay. All right. I'll do that in a sec. So let's get this done. All right. So here's the daily S&P chart I'm putting up.
Great. We love seeing S&P charts.
I know. I have an affinity. I don't know why. I just have an affinity to the S&P. Here's an S&P chart. Now, on TradeStation and probably on quite a few of the platforms now, they have this thing called the Ichimoku cloud indicator. So I just highlighted it. I'm going to put it on the chart. It puts all these curves and things. You see how there's this let me get rid of you see how this region, which has got like dots, red dots.
Yes.
That's the cloud. Okay. It's a way of telling the trend. So when the market's underneath the cloud, the market is, the price action is underneath the cloud. That's still in a bear trend. When it's above the cloud, it's in a bull trend. And what I did was, this is the original settings that are the default settings for the Ichimoku cloud that were developed by the original inventor, 60 years ago. And it turns out they work extremely well on the weekly time frame. If you have weekly chart data, weekly bars. But on the daily chart, this is a daily chart, they're okay, but they're not as exact as they work well on in other words, they're more predictive on a weekly scale. So what I did is I modified the settings. I went through multiple thousand combinations with my software, and we found a bunch of settings that are much better than the original settings. And those settings allow us to develop a system, and that system is an entry and exit. So it's an actual trading system that you can use to buy. So for example, you would have bought the S&P in here based on the rules that I have.
Okay, so that would be about April-ish, May.
Yeah, you would have bought it May 4th or so.
Okay.
And it worked extremely well on some markets the last few years. I mean, incredibly well on the yen, on Bitcoin. You see how you bought the S&P here, you bought it here. You sold it here. Let me put up Bitcoin.
Do you have stop losses with trading or anything like that?
Oh yeah, all of these have a stop. The system includes a very specific exit stop point. Let's see. Scale.
Okay. In case it doesn't work out. Okay.
Oh yeah. You can have losses. This is just a machine,
Mhm.
but it's a good one. It's a good machine. So let me put up the yen. Do you see this was 2021. You had a
Oh,
short
wow.
signal. It went short here. It went short here. That one would have got stopped down. It went short here. It went short here. It went short here. It went short here. See, it's a really good entry technique. And it went short here. And then it didn't buy here. It did buy here, probably made a little profit because it came back down again. It went long here. And then it started winning again.
Oh,
it went
yeah,
short here.
look
This
at
is more
that.
recent. Went short here. We're still short. Gives you an idea. And so that works. It works on the S&P really well. It works on the bonds really well. Worked on gold really well. Worked on dollar, US dollar really well. It's really well. So
Wow, very cool.
yeah. And I threw that in as one of the kind of things in the course. It's in the last lesson. It's a small part of it. I give away this to the students, but there's also on my website. I have you can buy this by itself, just I don't know, a couple $100, whatever. And it's a useful tool. It has the settings. It's just the settings are different than the normal settings. That the normal settings they're not bad, but they're just not as good. So
Mhm.
that's what
It is. Great. So the modification to it, and
Yep.
it looks really cool.
Yeah, and it's the computer helped. I mean, we just went through every conceivable, imaginable combination.
Absolutely. Wow. This is
Yeah,
so awesome. Thank you so much for sharing that. So
you're
now to Vedic astrology.
oh boy, now we get to the good stuff.
How long have you been doing that for?
1988.
Wow. Oh, and I wanted to ask you, so all these algorithms, these patterns, all of it, step cycles, did
Right.
you find them or did they find you?
I can't. Well, I invented a lot of the stuff that
Were you searching for these things or you just
yeah,
came
I
across
was
them?
searching for them, but you don't find them. They have to show up. They have to kind of pop into your head, you know.
Yes, exactly.
It's like you can't force it. That's why it takes time. It takes time, over
That's
many
exactly
years of
it.
yeah.
Agree. You
You
can't
want
force
something.
it. Yeah, the more you force it, the more you seem to want something so much, and it's like you don't find it. They say that with a spouse or anything, that you don't find it. But then when you finally just stop with that searching and you just settle in and you meditate or you get into a more of a different mental state, it's like it sort of comes to you. It's amazing.
Exactly. Yeah, I meditate. So I
Yeah. Me
actually
too. What type of meditation do you do?
I do TM.
Very
TM.
nice. I love transcendental. That's great.
It's a really I've been doing it for a long time, since 1974.
Good for you. Wow.
Yeah.
That's so cool. I do Zazen.
Cool. I mean, the whole point is you want to get to a place which is deeper inside yourself, because the potential that you have and the potential that we all have is so huge and so untapped.
Agree.
It's a way to just tap it.
It's infinite. The possibilities are infinite and anything is possible. So we just have to believe, and we have to, I do believe meditation is key, and just reach within ourselves and
Absolutely.
just, and that's it. It's great.
All right. So now I'm going to start with a little bit about the astrology. It's a big subject, but the main thing that relates to what I've been doing is the idea of history repeating. Okay. And so we actually have another YouTube site.
Oh,
Yeah. It's called History Cycles Reveal the Future. History Cycles Reveal the Future. And in that site, the only thing that we talk about are patterns of history that are repeating based upon cycles that I located that are based on the astrology. So a particular configuration happens up in the heavens, and then the same configuration doesn't happen often. Maybe it happens 900 years later. And I say, this is what happened on Earth. And when that same configuration happened the next time, this is what happened on Earth. Okay. And the reason is because there's so much similarity between the first set of events and the second set of events that it's striking. It's striking. Okay. And I'm going to give you a few of them. And I'm not getting off topic because I think this is in line with what you want to know. I'm going to review certain things in history that are happening at intervals which I can predetermine. In other words, the cycle that we talked about, the 60-year cycle and the 20-20-20, okay, that is generated by the astrology. The 20-year cycle is the rhythm from the viewpoint of the Earth, which is called geocentric astrology, is when Saturn and Jupiter come together. So when Saturn and Jupiter come together from the viewpoint of the Earth, and then they begin to, Jupiter moves faster than Saturn. So Jupiter moves away from Saturn. 20 years later, it comes back and runs into Saturn. So the cycle of 20 years is actually generated by what's called the Jupiter-Saturn synodic cycle, SYNOD, synodic cycle. It's a common astronomical term, synodic cycle. You know, new moon and full moon, right? When the moon and the sun are conjunct, then you don't have a moon anymore. And then 29 and a half days later, it happens again. So you get a new moon when they're together. You get a full moon when they're opposite. Okay. Similarly, Jupiter and Saturn come together, and then 10 years later they're opposite, and another 10 years they're together. So from together till together, from conjunction to conjunction, is 20 years. However, the second time it happens, it's not in the same part of the zodiac. They come together, but in a different part of the zodiac. So 20 years goes by and they come together. Another 20 years goes by and they come together again. The third time they come together is in the same part of the zodiac it was 60 years ago. So the 60-year cycle is generated by an astronomical combination of Jupiter and Saturn meeting in the same location that they were 60 years earlier. So that is a cycle, but it's not the biggest cycle because there are other cycles that are moving around. You have Mars moving around and you have all these other planets moving around. And so if you wanted to get, let's say you wanted to get all 9 planets in the exact same place they are now. The logic would be, if all the planets are in the exact same place they are now, the effect that's happening on Earth would be very, very, very much the same as what the last time they were in the exact same place. If they're seemingly causing what's happening, when they're in the exact same places that they were the last time, then the exact type of repetition of history should happen. That's the logic. But you can never find them in the exact same place. It would take millions upon millions of years for all of those planets to be in the exact same, because they all have slightly different rates of movement and they don't quite line up. But what I found was when Jupiter, Saturn, and the 2 nodes, Rahu and Ketu, in Vedic astrology, the north and south nodes of the moon are called Rahu and Ketu. When you get the 4 of them in the same place they are now, you get a humongous amount of repetition of history. You don't need all the others. You don't need Mars and the sun and the moon in the same places. But if you get those 4, it's like the backbone of the structure of time. But even that takes a long time. You know how long it takes? 1,768 years, almost 2,000 years between the four of them to be in the same place they are now. And if you look last month, a month before that, they were in the same place 1,768 years earlier. So it's like a rolling, changing thing. They're in the same places they were, and they're in the same places they were, but you got to stick with that 1,700-year interval. And then you get a movie. You get frame number one is matching frame number one, and frame number two is matching frame number two. Frame number three is matching frame number three. Movie script number one is matching movie script number two. And it really works. I'll give you some examples. So starting with a smaller one. Well, I'll give you the one that's the coolest is the Roman Empire, and the beginning of the Roman Empire lines up with the beginning of the United States of America. The beginnings of the Roman Empire, 1,768 years later, line up with the beginnings of George Washington and the thing, okay? And the United States presidents, now we're at 45, 46, they line up with the Roman emperors. You can line up, Marcus Aurelius lines up with FDR, Franklin Delano Roosevelt. And during the time of Marcus Aurelius, he was involved in what was called the Second Marco-Cavanian War, which was a war of Rome against the Goths. The Goths were the Germans. Franklin Delano Roosevelt, the Second World War. Second Marco-Cavanian War, Second World War against the Germans, okay? Do you know the presidents that aligned with Trump? Was a guy by the name of Decius, D-E-C-I-U-S. And Decius's basic shtick was make Rome great again.
Wow.
And he had this thing where he wanted everybody, see, at that time, Christianity was getting to be very big. And a lot of people were starting to worship the Christian faith, and they stopped doing the Roman go to Jupiter temple.
Yes.
And, so he had an edict that said, if you don't go and sign a paper in your temple, in your Jupiter temple, or in your, Athenian, whatever temple you go to, you sign a paper that I am still a worshiper of Jupiter, I'm still a worshiper of Venus. If it weren't for that, they'll kill you. And they did. They actually killed people who wouldn't sign the paper. So he wanted to restore the memory of the old Rome, of what Rome used to be, make Rome what it used to be, right? And the next emperor, his name was Valerian, V-L-A-E-R-I-N. And you know what his nickname was? And he lines up with Biden, okay? His nickname was the Old Man.
Wow. Well, that corresponds with our current state as well.
Exactly. And everybody's complaining about Biden's being old, So that's just simple.
It's history. What can they do? We're stuck in our historical patterns.
So some of the shorter cycles you'll enjoy also.
I have a question about so the United States it correlates with the beginning of the Roman Empire. How about the fall? The fall of the Roman Empire, could that possibly be the fall of the United States?
You got to hear this. You got to hear this. There was in England in the year 1600, December 31st of 1600, Queen Elizabeth I inaugurated a new company. It was called the British East India Company.
Yes. And
it soon became, over time, the biggest corporation that ever existed, ever. Larger, in terms of dollars, it had more money even than the biggest corporations today. And it went on and on and on and on until 1770. At one point, it was so big that it had its own army, had 250,000 soldiers in its army. And it had a deal with the British government that it would work together with the British government so that they passed laws that let them do pretty much anything they wanted. They had a monopoly on anything anything east of a certain point in the world, nobody else could go in there and own those shipping rights and stuff. 1773, 173 years later, the British East India Company had been so greedy that in some place in India, I forgot, in Bengali, India, they had gotten so much in taxes, they were collecting taxes, that they were literally taking money out of people's hands to such an extent that they caused an inflation that was so high that the price of food went through the roof. 1/3 of the people starved. The mayor of Bengal said that 1/3 of his population died from starvation. So this did a real number on the stock price of the British East India Company back in England, where they were publicly owned. There were a lot of people getting rich based upon them plundering. They also were involved in the opium trade. They were the ones who pumped all this opium into China from India. Anyway, so in 1773, in order to save the British East India Company, the government of England claimed they were too big to fail. Just like we just had the banks too big to fail in 2008. Well, they were too big to fail, so they decided to place a tax on some of the other places that they had colonies. They put a tea tax on the colonies in the United States of America in 1773. That started the sinking of, what was that called? The Tea Party, where they sank the tea and started the American Revolution. So because the East India Company was too big to fail, they caused the American Revolution, and 236 years later, which is 59, our cycle of 60, 59 times 6 of those cycles later, exactly on time, we have another crash in the market based upon having to do too big to fail saving. Okay, that 236-year cycle is a natural cycle in nature. 6 of those 59s, 6 of the 60-year cycles is a real thing. The United States of America wouldn't exist if we didn't have the financial crisis in 2008. That cycle caused the beginnings of the revolution that created the United States. All right. Wow. Well, it turns out that 236-year cycle is 2 times 118. 118 is 2 of the, 120 minus 2. It's 59 times 2. It's the synodic cycle of Saturn, Jupiter times 2. It turns out to be very, very, very important. 118 years in between major events. For example, remember Branson and Bezos went up in a rocket ship recently?
Yes.
And it was so cool. These 2 billionaires are competing with each other, and they went up for like 10 seconds and they come back down again, right? That was 118 years, almost to the day, when the Wright brothers took their first airplane trip.
Wow.
It was the beginning of airplane flight, and then now we have the beginning of space flight, privately owned space flight. That was a private venture also. The government wouldn't fund the Wright brothers. They had to get private money to do it. 118 years before that was the exact year that the steam engine was invented, when the first steam engine was existing. That was a transportation device as well. So you see how evolution takes place on rhythms like that. 118, 100, okay. Wow. Isaac Newton was born in 1743. He was born in 1643. 236 years later, 2 of the 118 cycles later, Einstein was born in Germany in 1879, 236 years. The life of Newton and the life of Einstein are so similar, you'd fall off your chair. They made their first invention exactly at the same age, and their first paper that Newton wrote was on what was called on the breaking up of light into colors, the spectrum of light being broken up into colors. But basically, you take white light, throw it through a prism, and it breaks it up into colors. And then you take a magnifying glass you can make it come back into white light, right? Einstein's first paper, exactly 236 years later, was on light, was on the photoelectric effect. Okay.
Wow.
And then Newton was studying gravity. Einstein developed that process of understanding gravity to be space-time curvature. Okay. And then at the age of 50, for example, Newton had a year where he was completely depressed. Einstein, at the age of 50, was completely depressed. Their lives were parallel all the way through. When Newton moved from Cambridge to London, he became the head of the Mint. That's when Einstein moved from Germany to Princeton, and they pulled him into the Princeton Center. Okay. 3 times 118 years is 354 years. Where I'm headed with this is 15 times 118 is your 1768-year Roman Empire thing, but I'm showing some of the smaller ones. In 1588, there was a thing called the Spanish Armada that was sunk by the British. There were a bunch of boats that were sitting in a harbor, and this British naval officer was trying to they were fighting with each other, the Spanish and the British, and so they figured out how to blow up a bunch of them, and he sank 36 of the Spanish Armada ships. 3 times 118 years later, within a month, Pearl Harbor, the Japanese sink a whole bunch of boats sitting in the harbor.
Wow.
In Hawaii.
Amazing.
There are so many. I can show you the relationship. There was a woman by the name of Eleanor of Aquitaine. Have you ever heard of her? Eleanor of Aquitaine. She was a very famous, in the Middle Ages, she was maybe one of the most famous women that ever lived back then. And she was a Duchess of Aquitaine. Aquitaine was in southern France, but she wound up marrying 2 different kings. First was the French Louis, I think his name was Louis VII, and but then they wanted to get divorced, which was illegal back then because they were Catholic. So anyway, she figured out a way to get a special thing from the Pope to allow them to get divorced, and then they get divorced, and then she marries the second king. Is a British king. I think he was Henry II or something. You'll have to check who was who. But anyway, she lines up exactly with Jacqueline Onassis 810 years later. There's a cycle of.
We all know Jacqueline Onassis.
And by the way, Jacqueline's favorite subject was French literature when she was growing up. It may not be reincarnation.
Yes, I was going to say maybe they're reincarnated.
It could be. But what's really wild is their lives lined up, because when Eleanor of Aquitaine got divorced and got the second husband, it's exactly when President Kennedy died, and she marries Onassis when Eleanor married the second king. She gets connected to Onassis.
You're quite a historian too.
Yeah, I've done a lot of work on history because it gives you a lot of conviction. Another one. There are so many of these, thousands of these things that you can see that are repeating, that are just unbelievable. Like give me a second. I'm just going to find something that.
I mean, we live life with an interdisciplinary approach. I do believe in that. And that's my theory with my investment and capital group, is that, it's about investing differently and using an interdisciplinary approach, because everything is interrelated. We live with everything, and it's all moving parts, and they're always moving. We're in a state of flux. We're always moving. So fascinating stuff.
Oh, yeah. I mean, the game continues. There's just a million things that are happening. I just want to find something that's really kind of fun.
Do you read a lot of books?
I don't read that many, but I do a lot of reading on the internet now, because now you can find anything else. For example, okay, so you want to know like what's going to happen now in the U.S. and
that's what we want to know.
It's like, how long is this chaos and craziness going to continue? And all this. So we did a study of 5,000 years of history, my wife and myself. And there's a particular configuration of astrology that's happening in the year 2042. So like what, 19 years from now. That configuration in Vedic astrology is that Saturn is going to be in the sign of Libra, Jupiter is going to be in the sign of Libra, and Ketu, which is the south node of the moon, is going to be in the sign of Libra. Those three. So we looked at all the times in history that that has happened before, and there were only 11 in 5,000 years. It's very rare. Okay. And one of the times, and each of those times, each of them turned into a period of great prosperity and great good stuff, a time of expansion, a time of increasing happiness, increasing support, increasing growth of wealth, and increasing positive trends, lack of war. Every single time this happened. And almost every single time, there was also the beginning of empowerment for women. There was a time when, like, the first Egyptian pharaoh, who was a woman, was her name was Hatshepsut, and she lived in about 1500 BC, and she came into power when this combination happened. And
2042.
2042. And so what I think, and I was looking at different women's charts, astrology charts, and what's the name of the lady from Minnesota, the senator? She was running for president last time.
Oh, yeah.
Whatever. Amy Klobuchar.
Oh, yes.
And she came through Iowa.
Yes. Democrat.
Mm-hmm. Yeah. And I looked at her chart, and I think there's going to be a woman president in 2038. That's my bet. That because the cycle is happening, and it tends to create more harmony. There tends to be more peace in the world, more balance. Money tends to get balanced out more. The poor people get less poor, and the rich people may be less rich, but it tends to go toward the middle a little bit more, and it tends to improve on equality and human rights. So we're moving in the direction about 15 years from now, where there's some really good events likely to transpire, and some of the negative stuff is probably going to end. And interestingly enough, in each of those 11 cases, the 10 or 15 years going into that period were tumultuous. There was a lot of chaos and noise and unstressing, you might say, like a lot of stress that was boundied about. And so I think of it as like leaving, it's like remnants of the past, the chaos that's coming through. It's stuff that was buried and it's starting to emerge through people's nervous systems right now, leading to a point where something really good will happen. And what did happen back then, also in every single case, was a powerful leader emerged that was able to unify the world. And it happened in Rome with Augustus. Augustus was the nephew of Julius Caesar. And Rome was a republic from 500 BC roughly until roughly 0 BC. And when the first emperor in Rome was Augustus, and he really helped. And he came in around 27 BC, and he lived until 14 AD, and that 40 years, and he turned the corner for Rome. And then another event like that happened 270 AD. You have another one of these combinations, and there was a leader by the name of Aurelian, Aurelin,
Mm-hmm.
and he was called the restorer of the world when he was in power for 5 years. And I think somebody like that's going to come around either in 2040 or 2042, around that. One of those elected officials will be a very powerful person who will really whip things back into balance, away from imbalance. Hatshepsut did the same thing. And other female leaders along the way show up around the time of these conjunctions. So it moves in the direction of more maternal and more female energy, becomes more accepted.
And
more
how
powerful.
long will that time period last, do you think?
In each case, it was at least 150 years. Wow. And I think we're at the crux of a bigger cycle of a turn. And you know what Kali Yuga is in terms of Kali Yuga? There are in the Vedic literature, they talk about huge cycles of time, huge. There's one that's 1.2 million years. And it's broken up into 4 cycles. And one of them is four units long, and then 3 units, and then 2 units. And the smallest one is called Kali Yuga. It's 142,000 years. Kali Yuga is 142, and that's the littlest. But it's also like the winter. It's when things are the most dark. And the world went into Kali Yuga in 3102 BC. We've been in it for 5,000 years now. And I think what some of the sages are saying is that 5,000 years into it, you also have it in the Christian tradition where Jesus is going to come back, and in the Jewish tradition where there's the Messiah coming back. This is a period of 10,000 years that's going to start up in the next few years, maybe 15 years, maybe 8 years, I don't know. Somewhere in the next chunk of time, we go into this turn, major turn in the path of history, where the darkness that's been getting bigger starts to reverse for thousands of years into the future. Wow. And I think that period is going to start minimally. It starts in 2042, but it could start in many cases. It started a few years earlier, and it was noticeable before. But that was when it was most, full on, completely there. Okay.
That's so amazing. So we expect some craziness now, continuing until the maybe late 2030s to 2040s.
Yeah, and it fits in. I mean, the economy is going to have to fill, like if we have a decline in the stock market from like 2033, 2034, and then it stays down for 8 years, that winds up at 2042.
That's it.
And that's the turn. And so during that time is when everything gets redone, reconfigured, restructured, in a better way, in such a way to kind of come out of it. You've heard of the fourth turning, right?
Yes.
It's the same thing. It's like he's saying we're in the fourth season of the fourth turning, and we're in the bad part, and it goes on, and he thinks until 2029 or something. But I lined up his four turnings with the astrology, and they're caused by these planetary conjunctions and separations and conjunctions and separations. Lines up exactly with the generational changes and the psychological redefinition of, in one generation, in the hippie generation, it was all about getting together and unity and community. And then later on, it's like, no, I'm on my own, it's me, So these psychological changes will change as well, but we're in a great deal of transition. That's what's happening right now. It's a very powerful time.
Period of transition. I love this. This has been amazing, Allen. If you could just sum it up for us, what you foresee, let's predict society and the market. Just give us a synopsis. We're in 2023 right now, almost October, September, October. Now until, let's go to 2050. Just give us a bird's eye view, just an overview.
Okay, an overview. So starting with the stock market, we're looking at a phase of topping and correction, and including a potential 50 or 60% correction before it's done. And that all reverberates around like in the 1960s and 70s. You could follow the 60-year cycle as a good example. Then you start up again. Then you get another bull, okay? So from 2042 on, it could be dramatically better.
Ooh, okay.
The gold market is probably going to be in a recessionary psychology rather than a bullish psychology, at least until 2027. And then it goes bullish. Then it takes off. So gold would be a value. Bitcoin is hard to say because there's not that much history on it. I wouldn't want to make an opinion on that because I don't have the tools to evaluate it correctly. The currencies obviously are related to the dollar, is related to the interest rates. The likelihood again is interest rates will probably go up because there's a 60-year cycle in interest rates. We were off by about 2 years, but we're in the beginnings of an increasing phase of interest rates. We're in the beginnings of remembering value. We're in the beginnings of getting away from the craziness and the speculative fever where value is irrelevant and corporate buybacks rule the world and zero interest rates allow people to borrow money for free. And all that's ending. We go back to the ground. The ground is where things are real. And so that by 2042, we're back on the earth. You start operating in terms of values that are more sensible and more realistic, and probably more long-lasting for the future. I'm not a doom and gloomer. I'm not thinking the world's coming to an end in terms of the environment. But I do think we're going to go through some chaos because 3,000 years ago was the closest analog to the present civilization in terms of environment and in terms of temperature changes and stuff. And there's a 3,080-year cycle in the astrology, and it's repeating. And that indicates that we will have an extreme level of increasing environmental stress that goes on probably at least until the 2050 area. And I think it's going to normalize. But one way it normalizes, the hard way, is that there's a volcano that blows up and it covers the earth with ash, and it blocks the sunlight and everything cools down. That's the way Mother Nature is going to be here. The earth is going to be here. What we do, it's like that. I'm not worried about the earth. I think it's what we do to ourselves here. The earth will find a way to protect itself, you know? So I do think that there will be additional work needed to offset the environmental heat, particularly, that's going to be happening. But initially, there could also be a cooling phase before the superheat comes in, which is probably coming in the next few years as well. That's also cyclical. And then I believe we'll find a way to, find solutions. I don't think we have to leave the planet. We don't have to go to Mars. We don't, we have to hang out on Earth and do our job. The currencies, obviously, currencies are related to government. They're related to interest rates. They're related to a lot of values that have nothing to do with reality. And so they're probably going to normalize into such a way that in the future, there will be some standard of value based on something real, maybe gold. And many of the currencies are going to have to go back into line because they're going to get so inflated. They're going to get so hyperinflated that in the long run, they'll have to either be eliminated or some universal variation on currency will have to come up. But that's a long way off. It's not an immediate thing. There was one other thing I was thinking. That's pretty much it. I'm pretty sure that the price of the dollar, the US dollar, is not going to die. People are worried about the dollar going down to zero or something when the BRICS nations come together. No, dollar will be strong for a long time, but it's not going to be the only thing. I mean, obviously there'll be alternative currencies. We have 300 million people here. There are 3 billion people in 2 countries in the other part of the world. And India is going to rise. China's not going to be as big a thing as everybody thinks. India will be, though. India is on the rise. The demographics that what's his name? Harry Dent talks about.
I like Harry Dent. Yeah, he's good.
I think he's right. I think he's
good. I think
China population is declining.
I think China's post-peak as well.
And India isn't, though. India's going to. Do you know India is changing its name? Did you know that?
No.
The president of India in a few days is going to announce that India is no longer called India. It's going to be called by its original name was Bharat, B-A-R-A-T.
Oh.
Yeah, Ved Bhumi Bharat, the home of the Veda.
I guess I've been living under a rock. I've been so absorbed with studying economics and all these markets and podcasting.
Well, I don't think it's been announced. I don't think it's been announced. I heard it from
That's
somebody.
amazing. I have to wonder, do you coordinate with Nostradamus by any chance? Is your life cycle with him? You're like the modern day Nostradamus.
I don't think I would think of myself as but what I do like to think of is that I'm not thinking of myself like I'm a psychic, I'm doing all this stuff with numbers and math and repetition of patterns, because when I feel open and I see the patterns repeat, I say, this is real. This is the way it's supposed to be. It's not an accident. The whole thing is there's some order in the universe.
There is,
and it's not apparent on the surface, particularly in times of noise and chaos. It's even less apparent. How could this be? How could this be? How could this be? But we're going through a phase, and the phase will end, and it'll wind up being okay. The main thing is not to blow up the world with nuclear bombs, before then, because it takes a long time to get rid of the radiation,
Absolutely. We will be okay, and there's hope. There's always hope for tomorrow.
Oh yeah, definitely. And I think you're right. You do need to do something. You need to meditate. You need to do something to offset the chaos. You need to do something to
detach from electronic devices helps as well.
We're in a place of increasing activity.
Increasing entropy. That's what I like to call it. Rising entropy.
And you need to find something that'll create more order and more balance
Serenity.
and serenity. And people go to the Hamptons, right?
Oh gosh. Yeah.
And I
I
wouldn't
guess-
call peace.
No, not at all. I've been out there during the summer. I try to avoid it.
I know. But fortunately, Iowa has some remedial value.
I love that. You're in Iowa. This is so cool.
Yeah.
Allen, this has been absolutely amazing. I look forward to meeting up with you again. Please tell our audience how they can find you.
Okay, well, my company name is Trade Forecast Mastery, tradeforecastmastery.com. And my YouTube site is Allen Reminick, just my name, Allen Reminick, Allen. And the other site is History Cycles Reveal the Future. That's for people who are interested in the history repeating. The stock market stuff is all in the Allen Reminick thing, and we've been doing that for a couple of years now. And I update it fairly frequently for people who are interested in following the S&Ps and stuff.
That's so
it.
awesome.
This has been so nice, and I thank you for inviting me. It's delightful to meet you, and it's really fun to be here and do this.
Thank you. This has been so much fun. Thank you so much. I'm going to put all the websites and all the YouTube channels in the description for everyone to follow you. Thank you so much.
Thank you very much, Rosa. Be well.